Hello guys and welcome again to my accounting YouTube channel where I translate technical and complicated accounting lessons to a storytelling version, sort of. So in the past episode, I taught you how to make an amortization table and we compared the timeline versus the amortization table. So in this particular episode, I would like to present to you the alternative journal entries related to loans receivable. So in the past episodes, I told you that I prefer these direct to the point entries here. Okay? But in some textbooks, the journal entries are not like this. However, let me emphasize that the substance of these direct to the point entries and the alternative entries that we are going to talk about later is practically the same. So let's have at it after this. So again, these are the direct to the point entries. So let's go with the initial entry. So in the direct to the point entry, the beginning entry is just debit loans receivable and then credit cash for the net amount already, which means it's the principal and it's been deducted already with origination cost received from the borrower, and of course, the initial direct cost incurred by the creditor has already been added. Okay? So it's as simple as that. In some books, their entries in the initial or the beginning period is not like this one. So their first entry is debit loans receivable and then credit cash for the whole principal amount. And in this problem that we are solving for, that's 5 million. Okay? So that's their first entry. Now, they are going to make a separate entry for the origination cost received from the borrower. And that's debit cash and then credit a new accounting title, unearned interest income. So in this problem, that's 275,000, which is derived from 5.5% based on the problem. So 5.5% of 5 million, that's 275,000. Okay? Now, aside from those two entries, another entry is also made for the direct origination cost actually incurred by the creditor. And that's debit unearned interest income for 44,779 and then credit cash for 44,779, which is also mentioned in the sample problem. Okay? So, if we compare these two type of entries, so this direct versus this alternative entry, the alternative uses a new accounting title, unearned interest income account. So what is this? This is just a contra asset of the loans receivable account. So it's similar with the allowance for doubtful accounts, which is a contra asset of accounts receivable. So that's the unearned interest income. So meaning, even if these are your entries at the beginning of the year, if you are asked, what is the loan receivable balance? You cannot say 5 million because the answer should be this loan receivable, which is 5 million minus the unearned interest income. Okay? Which is the net of these two. And if you're going to do that, the resultant will still be 4,769,779, which is the same with this one. And you can check on that. Okay? Now, let's move on. What about the entries in the subsequent periods? So, the entries in the subsequent periods are these. So, what did you observe? Okay, let's focus on the end of year 1. So are these direct to the point entries similar to this alternative entry? Of course, yes, right? The only difference that they have is that this here uses the account unearned interest income instead of loans receivable account. Okay? And if you look at the other years, the same difference is also happening. Okay? So it's as if in these alternative entries, the loan receivable account is just increased once, here at the beginning. And it's ultimately closed at the end of the maturity term. So as if it was only used twice. Okay? So compared to here, in the direct to the point entries, the loans receivable account was used constantly. That is why the loans receivable account kept fluctuating every end of the year. Because again, the direct to the point entries do not use the unearned interest income account. But then again, the substance of these two sets of entries, this direct to the point and the alternative ones, are very much the same. Okay? So that's it. Again, I taught you these entries, like the amortization table before, because in some questions, you might be asked about journal entries. So if it is a multiple choice question, and if in the multiple choice question, these entries are presented, the entries using the unearned interest income, you will be confused if you only know the direct to the point set of entries. So that's that. Now, before we end this episode, let's make a little twist in our sample problem after this. Since we have already talked about the entries and the subsequent measurement of loans receivable based on our sample problem, let's answer the question, how about if the debtor experiences financial difficulty and that the debtor can't fulfill 100% of the agreed payments? What will happen? To illustrate that, let's make a twist on our original sample problem, okay? But before that, here is our original sample problem. So BBG loaned 5 million to BBM with a nominal rate of 10%. However, BBG collected or deducted in advance 275,000 origination cost from the borrower. And also, BBG incurred additional direct origination cost of 44,779. And because of those origination costs, the loans receivable was initially recorded at 4,769,779 instead of 5 million. And also, because of that, a new effective rate was computed. And that was 11.5%, if you can still remember. Now, let's add something. So, BBM, the debtor, at the end of year 2, unexpectedly requested to modify the terms of payment. So, the terms are the following. So, BBM is to pay 4 million principal only at the end of the maturity term. So, interest will not be paid already due to financial incapacity. Of course, BBG will investigate. So, based on BBG's sources, BBM is actually already starting its process for filing bankruptcy, which is why BBG agreed to the modified payment terms and concluded to recognize 100% of the possible impairment loss. So, that's the twist. So, in this added twist, let's assume that BBM, the debtor, paid all of its obligations until year 2. Now, the questions are the following. What will happen to the loans receivable at the end of year 3, end of year 4, and end of year 5? Both concerning the measurement and the journal entries. Next, will there be an impairment loss? If yes, how much? So let's answer those things in the next episode to keep this video short. So if you've learned, please click like, subscribe, and hit the notification bell and select all to be updated on my next episodes. So again, thank you for watching, and always remember, even though there are no shortcuts in learning some accounting topics, especially the difficult ones, there is always an easy way to understand complicated things, and you need to find that. So see you on my next videos.